because it gives you a very decent amount of leverage while still, giving you you know, pretty cheap options play. There's a chance to run on 1119, right? But the real fun if the next week, I don't think there's a chance to run on 1119. If they started to cover, I'd be so happy. Yeah, so kind of like what happens is if back to you, Danistan, if the price runs up to the point where all contracts are in the money, they can no longer hedge. It means they can no longer hedge variance or volatility. No hedging volatility. And so so basically what would happen is then their volatility position blows up in their face, right? And that can then launch us like the price higher, obviously, which puts us in the gamma squeeze. So volatility squeeze into gamma squeeze into and then the price getting even higher than that then exposes the short positions. And the beauty of like options during this period, right, is that applies additional pressure, especially if those are being exercised. I've told you guys a bunch. I cannot predict the upside. I know, if we look at the technicals, we can try. Hold on. So if we go out here and we look at the technical indicators, like we can kind of try to figure out, where we could have run. Let's say the price action from. This is interesting, right? Because we had all of that price action play out. Like let's just say we take. I guess like this one. Oh wait, hold on. Like we can only compare it historically, right? So if we take the price action from, I don't know why that's doing that. Hold on. Here to here. Move that. And we started right where we're at now. Like that's what June's exposure would look like at our current price level. So testing almost 300. If we look at, August 24th, also about there, like 280, like the 280 range. But we also have a gap there. So there's a gap like right here. And if we break that gap, we can, fill and run even harder on the November 24th, 23rd, 24th. And historically, we've never hit we've never actually hit a gamma exposure date with our price this high, with this many more contracts in the money, and that makes a huge amount of difference in the amount of relative exposure that we expect them to have. And then also, the stock becomes more and more illiquid every day, and so those upside movements become more and more violent. man, I am just going to catch up on chat. And then if I missed your thing, I'm sorry. You sound a lot better now in the new home. My ears say thanks. That's awesome, Victor. What exactly is a gap and how does it form? It's just essentially a block of price action that gets skipped over by a stock gapping up or gapping down. So when there is a significant gap in the order book, right, and the stock's trading here, and then it gaps down to this price, that means that no shares are traded in this window. And usually, but not always, shares will then trade at that price to fill this gap in the order book. Is there a certain percentage of Jan Feb calls that you think you may take profits on in late November, assuming we run? Yeah, I'll take money on the further out of the money ones. Depending on how hard we run, right? Like if we run super fucking hard, I'm going to take probably profits from across my entire position. But I'm also like, I'm going to leave, most likely leave my Jan and Feb through, because like these will spike and stay up. And I'll leave those running through the roll period to protect in case they do roll the contracts. Right? Because like after that run, if we have this period where we don't know what's going to happen. They either roll or they don't. Okay. And so if they don't, the price will trade flat. If they do, then the price will continue upward. And so by having Jans and Febs during this period, I can just watch the price action, right? Like they'll already be in the money. Then the only period I know for a fact that we'll likely see a dip is here between December 22nd and January 12th. Nothing happens during this period. Like generally speaking, like we may go up, but slowly, right? And this is probably the ideal time to reposition if that's something you're looking to do. Like if you've taken profits after this run. But right, like remember, like the two expected price actions are up here and then flat into the roll, or up here and then up, right? Either way, though, once we get out here to December, we go up again. And then from this period in just after just the first ETF leap expiration until the FTD cycles start to pick up in this window, it should be pretty flat or down. And so this is the best time to reposition or expect a dip in IV throughout the whole cycle. Once we start hitting those ETF and GME FTD windows, like I expect the price to continue up until this last date where I expect it to kind of rocket. I know that was a lot. Farming Hobo, thank you so much for becoming a Cornishon, man. I appreciate it.
Welcome to Cornishon. Cornishon. Cornishon.
Clip it? All right. Yeah, I'd imagine people will want to try to dig through all those thoughts later.